Let's bring in Russ, Koesterich, BlackRock Global Allocation Portfolio Manager. Thanks for joining us, Russ. Good to see you. What is your take as to whether we're past the worst of the inflation scare for U.S. equities or not?
I think we have a few more months left of scares, or at least some uncertainty, and probably a bit more than that. You know, there's a lot of talk about inflation being transitory. I think that's right, but we have to define what transitory means. I don't think transitory is you've got another month or two. It's very likely, given the base effects, given what we're seeing in wages, given what we're seeing in supply bottlenecks, that the upside risk on these inflation prints is going to last several quarters, not just a couple of months. So I think this is something we're going to be focusing on probably for the remainder of the year and into 2022.
What about you? So what does that mean for your equities exposure, both here and abroad?
So I think it means a couple of things. You know, the market can live with some inflation, particularly if it's happening in the context of these just incredible growth numbers. You know, again, you know this as well as I do. We're looking at some of the best growth we've seen in decades. That has an incredibly powerful effect on the top line. And it means, as we saw in Q1, that earnings can continue to be strong, even if the input prices are rising. Having said that, it does make a difference in the type of equities you're in. And while growth has come back a little bit in the last month, it's still an environment where you want to be levered to cyclical companies, whether we're talking about manufacturing, basic materials, some of the financials, consumer companies that are going to be the most geared to that sharp rise in nominal GDP.
Everything you're talking about, Russ, the fact that the economy is continuing to look strong, it's booming right now, the numbers look great, inflation is heating up in many pockets of the economy. You would think this would all be very bad for bonds, and yet they've caught quite a bid here with the 10-year yield at 148. So explain what that's telling us.
Well, I think, let's be honest, it's a bit of a mystery and it's hard to explain. I think the simple answer is you have tremendous flows coming into the market that need to be put to work. You've got flows from institutions. You've got flows from asset managers putting that institutional money to work. You've got flows from retail investors, an aging population looking for income. So I think the reason we're seeing the bond market as resilient as it has been is that there's a lot of money that needs to be put to work. Having said all of that, I do think we're going to see yields higher by the end of the year. And I just cite a couple of simple statistics. Real 10-year yields are around -80, -90 basis points. That's pretty much where they were back in early November, before the last two rounds of stimulus, before we knew about the efficacy of the vaccines, before we knew about how effective the rollout was going to be. So the notion that real yields haven't budged, despite all of those developments in the real economy, is really hard to fathom. I do think we're going to see an adjustment in real yields as we get into the back half of the year.
Shepard Smith here. Thanks for watching CNBC on YouTube.